Martin Klein, shares of Genworth Financial are up 15% this year, 70% over the past year. You're outperforming your peers, so tell me what's driving the stock.
Well, we made a lot of headway in doing the things we said we were going to do and executing our strategy. So we've taken a lot of strides in improving our earnings performance, particularly in our long-term care businesses and our USMI businesses. Taken a lot of steps to increase our financial strength and flexibility. And we've simplified the company. We sold one of our non-core businesses last year to generate capital. So those are all the things that we said we wanted to do, and we've made good headway on it. So the stock has reacted nicely.
You're also having a big week because you just underwent your Australia IPO. I think it was the biggest IPO in Australia this year, raised a lot of capital. What kind of flexibility will that give you?
Well, we just priced it, so it's going to close next week. But it's been a long-time objective of ours. It'll help rebalance the risk that we have in mortgages. But once we've generated that capital, we can use it to make sure our businesses are appropriately capitalized, especially our U.S. mortgage insurance platform as we look at new potential capital requirements. And then also look to take down some of our debt and work to de-lever to our longer-term objectives.
All right, let's talk about your U.S. business and your mortgage business. Your net operating income was up 20% the last quarter, helped by the housing market.
Yep.
That said, we keep hearing housing is slowing in the U.S. With every new economic release, they say it's slowing, getting worse.
Right.
What does that mean for Genworth Financial?
You know, I think the recovery, we still think it's going to be very gradual, but it's going to have its fits and starts along the way, and I think we're starting to see that a little bit. I don't think that we're calling for that to really play out over the longer term. We still think we see conditions that'll be a fairly steady but pretty slow recovery, and we think that'll be helpful for the business.
Also in the first quarter, according to your earnings call, a lot of people died in the first quarter.
Yes.
Higher mortality rate didn't help you with regard to your earnings, a little bit of a drag. How can you overcome that? It's hard, death is a part of life.
It's one quarter, and in fact, last year we actually benefited from mortality that was lower than we had priced for, so not that many people died. So it's volatile and it bounces quarter to quarter. We think our products are appropriately priced for mortality right now, but it's something we'll continue to watch.
And then finally, you mentioned it before, what are you doing to expand your long-term care business? Got 70 million baby boomers out there, 10,000 each day are turning 65 or something like along those lines. How are you going to take advantage of that?
It's a huge area of focus for us. We think we've got a lot of competitive advantages. We've been in the business for a long time. So we're looking to increase market awareness. I think a lot of people aren't really aware of the need for long-term care. And so we want to increase that awareness. We're making investments in distribution, and we're making investments in new products and looking at that. So it's a big opportunity for us.
All right, thanks a lot, Marty.
Thank you.
And thank you for watching The Street.